I think the PMIs will be an interesting set to watch out. I think there might be coming some sense of reality back to markets, that things aren't looking as good as we've priced them, really. I think when you look at what's really priced into markets, you've just mentioned the PMIs. If you compare them, for example, what's priced for equities, you're definitely pricing at PMIs across the globe, whether that's global PMIs or whether that's a US ISM above 50. The same goes for investment-grade credit or for high-yield credit that now has recovered so much, particularly in the US. And that's also pricing ISMs and PMIs above 50. And really, what that shows is that markets have moved so much in favor towards a sort of very swift and imminent recovery. And in a way, it's now showtime. It's now really the time where you say, look, put your cards on the table and really show us that swift recovery is imminent. If that doesn't happen, I think actually stocks and risky assets in general are still very much prone for some downside in the near term.
Max, can I just look at the factors why we've seen the markets up so strongly, and yet the PMIs and the underlying economic data are a little bit ho-hum still? And it seems to me it just comes back to M1, M2 and these multi-decade highs we're now seeing on the money supply numbers here. And of course, if you continue to throw enough money at the economy, it has to go somewhere. But my suspicion is that it's just going to continue finding its way into financial assets, because creating money supply doesn't create underlying demand in the economy. So I'm just wondering if we can continue actually to see economic data deteriorate and financial assets go up in value as they did back after the financial crisis, when markets react to the additional liquidity, but they don't take any notice of underlying economic weakness.
Yes, that's a very good point and a very fair point. I think in the short term, yes. In the short term, absolutely. It's very difficult to gauge when this is going to end and when really the reality is going to kick in. I would just add perhaps three things. What's been driving this? I think number one, just as you said, whether that's credit impulse data or M1 money growth. The second one is clearly sentiment and positioning. There are some very high cash balances out there still, so cash has to be deployed. And I guess number three then is clearly momentum, right? Because you've seen those tech stories rally. In reality, ex-US equities, whether that's the Eurozone, we've just heard about Germany, whether that's Japan, whether that's EM. So really excluding the US from the equation, actually markets have moved broadly sideways. So the same goes for credit and investment grade. The same goes for high yield, for EM debt as well. So that's been sort of broadly moving sideways over the last 5 to 6 weeks. It's really been the momentum in the US and most strongly in tech. So it's really also been this third momentum factor, I would say. I would say in the short term, yes, absolutely, that can continue. But nevertheless, if you look at what's priced in right now, and if you look at these charts, let's say ISMs or business confidence more broadly, or consumer confidence, consumer sentiment, and you plot them against markets, so the sort of macro against market plots, if you look at that, even the last 10 years, that actually was tracking each other very, very closely. So in other words, what we got used to in the last 10 years is that central banks were acting very preemptively. They went in very, very early. And as a result, we were used to that after a couple of weeks, sentiment more broadly in the real economy was picking up as well. So in a way, then the sort of preemptive pricing higher in risk assets, that made absolute sense. And you could justify that on an ex-post basis because obviously the data were then picking up. And then you could say, look, there's no divergence anymore. It's fine. That really could be different this time. Because who is to say that consumer sentiment, consumer confidence, or like you mentioned earlier, the demand side more broadly is going to pick up so swiftly?